There's a strategy out there that's so unbelievably simple, yet it outperforms one of the best performing asset classes over the last 25 years. The Q is a collection of the best performing and thought to be the strongest technology companies on the planet. And it didn't just beat the Qs over that time. It absolutely demolished them by about 300 percentage points. Now, usually when you think of trading a strategy, you think of looking at lines on a chart. You think of doing some complex mathematics like all the quants do. And no, this is a lot simpler than that. So simple, I can almost guarantee that you've seen or at least heard of it before. Now that begs the question, because we've all heard from the expert, the Oracle of Omaha, Warren Buffett himself. His philosophy has always been one that's relatively simple, one that we all know at this point: buy and hold, right? Pretty simple. If they're simple, that's the most simple it's gonna get. And he preaches this statement that we've all goddamn heard by now. I can almost guarantee your mom, dad, sister, brother, stepdad, stepmom, dog has probably heard of this philosophy by now. Time in the market beats timing the market. Warren Buffett has actually said this before. Market timing is both impossible and stupid. So if it was impossible and stupid, why would anybody dare to try and outperform the market? Outperform this number right here. Why not just buy and hold the Qs, some of the best technology stocks to exist on the planet today? But then we have strategies like this one that we're going to talk about shortly that has outperformed one of the best performances over the past 25 years by about 300 percentage points. Now, I don't think Warren Buffett actually means it's impossible and actually means it's stupid. I think he's more referring to this as impossible and stupid. You know, trading 0-day expiration options that are way out of the money with basically a 99% chance of loss. In other words, gambling. And yeah, it could end up like this. It could end up with you losing literally all your money, blowing it day after day with this nice downtrend. Or you could always get a little bit lucky. You could always gamble on Kohl's shares going up 20% by the next day, I guess. That is a way you could win. And that is a valid trading strategy. But the odds that you succeed over the long term taking that approach are probably sub 1%, if not zero, because it is basically impossible and it is stupid. And another reason timing the market may be considered stupid or impossible is because we can't really predict what goes on a day-to-day basis. You could have President Trump come out with tariffs that literally would cripple entire economies and the overall world economy, and the next day stocks are getting absolutely massacred. Under no control of your own, you could have done all the analysis, you could have seen all the numbers, you could have taken a pattern that's happened 99 of the last 100 times, but no matter what, you couldn't have seen this coming, right? These things happen, these things are quite unpredictable, and if you're taking bets in a market that is unpredictable, then eventually you're going to lose. Let's just hope you don't lose it all at once. Now, I think you get the point. Finding a strategy that outperforms the Qs in this case is very, very difficult. But I'm telling you right now, you're aware of this strategy. And the strategy is subscribe to the channel. That's the strategy. You'll make some money. Now back to the strategy. SMA, simple moving average. A strategy that involves a whole two lines. One line, the short tail, that tracks the price a little more closely. Let's pretend it's your 10, 15, 20 day moving average. Just the average price over the last 20 days, for example. If you're tracking price over the last 20 days, it's going to be closer to the price than the longer tail, a moving average that let's say is 50, 100, 200 days. That line's gonna take a little bit longer to adjust on a sharp decline, sharp incline. I think you get the point. But the entire strategy involves buying when the short tail, the line that's tracking price a lot more closely, crosses over the long tail to the upside. The whole idea is that, hey, this blue line has been telling us that we've been in a recent downtrend, but once we cross back above this green line, the longer tail, the price data is telling us that there's potential upside here. the market momentum is coming back and crossing to the upside. Now, we're not going to talk about shorting the market, but again, another opportunity. There's momentum to the upside over the long term, but all of a sudden in the short term, for whatever reason, Trump issues crazy new tariffs, earnings come out and they're absolutely god awful. You can see price tanking. That's obvious. That happens all the time. Now, when people think of trading, when they think of quant trading, they imagine these people sitting behind their desk with thousands of computer screens, billions of different numbers, all coming together in this beautiful symphony of a buy or sell. Now, that is the case for some of those big quant firms, but at the end of the day, history gives us a clue into what could happen next. Now, again, another cliche in the trading world is past success is not indicative of future returns. We've all heard it, we understand it, but we also know history doesn't repeat itself, but it often rhymes. And now we don't have to be quant traders to use tools that are available to us right now, today. If we use, say, this backtester tool, we can look at how the Qs have performed since 2000 in a buy and hold strategy with an SMA crossover strategy, earnings breakout, what happens when the stock gets hot, what happens when the stock gets cold. These things, these insights are valuable and can help us make less stupid investing decisions, as Warren Buffett hinted at. And I want to show you exactly that. It's as easy as plugging in your ticker, providing a few parameters, selecting a strategy, and hitting backtest. And you have the ability to take advantage of data, to take advantage of numbers. What has history told us about how the Qs have performed and how they're likely to perform going forward? So if we just plug in the Qs, we have a start date of all the way back to 2000, and we pick a simple strategy like the SMA crossover. We have a fast or short tail that we described of 50 days, 50-day moving average, a slow or long tail of 200 days, 200-day moving average, and we run this back test. You can see all the stats right here. It's as easy as that. Starting with $100,000, you end up with 1.1 million, just about 11 times the money that you started with, a 1,000% gain. We can see here to get a feel for how exactly this strategy outperforms the pros, the people just investing in the Qs over the long term. After all, it's pretty sought after. Basically, every financial advisor out there has a benchmark that they have to hit to gain the trust and rapport from their clients, because let's be honest, if you're not outperforming the market, then anybody, even your grandmother, could go onto Robinhood and click buy on the Qs. If you're not outperforming the benchmark, then why would you be paying for a financial service to underperform the benchmark and make you less money than if you did it yourself? And I want you to notice what's happening here. So during a buy and hold strategy, you would have had to endure basically the entirety of the dot-com bubble, basically the entirety of the great financial crisis, all of COVID, and the recent panic when interest rates were going straight up to the moon because inflation was skyrocketing. This strategy, in this case with the Qs, practically dodged all of the pain that was experienced during a simple buy and hold strategy. If we go back, you can see it's pretty clear. During the dot-com bubble, the momentum was sharply to the downside, and because that momentum was to the downside, we got out of our position and re-entered when momentum crossed to the upside, crossed over this longer term moving average. And you can see the same thing repeated over and over again. This isn't magic. It's simply taking the numbers, the data that we have available to us, and using it to our advantage. Now, this doesn't always work perfectly, especially in very sharp and volatile markets. You can see recently during the April mayhem, during the Trump tariff mayhem, this strategy sold not at the bottom, but pretty close to the bottom, and bought back when we were nearing all-time highs on the market. So very stark moves like this one, like COVID. These are definitely anomalies in the data. We usually see downtrends play out over years and years, whereas these played out in basically 1 or 2 months, then the market went straight back to all-time highs. But either way, you can see the gap between this strategy and the Qs, our benchmark in this case, is astronomical. I mean, we're talking 384%. It's not even close. Now, is that to say that this strategy will guarantee that you sell out right before the next big crash and buy in right before the next bull market? Absolutely not. But what it is showing you is that outperforming the market, at least historically speaking, isn't as hard as you might have thought. Using a strategy as stupid simple as an SMA crossover can yield results that are practically unheard of, outperforming Wall Street, people who study the market every single day. And that's the power of mathematics. The fundamentals don't always matter. What you think definitely doesn't matter. Algorithmic trading makes up anywhere between 60 and 75% of trading volume. So if you're going to take a gamble, if you're going to take a strategy that's not just a buy and hold approach, you should definitely use the mathematics and the data that's available to you, especially when it comes in the form of a simple click, type what you want, test, and view the results. And again, this is just the beginning. I want to hear some thoughts. What strategies have you guys used in the past? Because every day I'm trying to implement at least one new strategy that can be tested and can be put through the gauntlet. Can we outperform the market consistently? It's not impossible, it's possible. Is it difficult? Yes. I also want to tie in testing on fundamentals. To grasp the entire picture, we need to consider as much data as humanly possible. In this case, we're just looking at something as simple as an SMA crossover. Has it been successful? Hell yes, it has. But the market's constantly changing. And as we can see, the strategy as of recently definitely wouldn't have performed as well. It's really the .com era that's absolutely carrying, and the great financial crisis, of course. But we've virtually been in a straight uptrend since then, so outperforming that is quite difficult. So looking next to incorporate historical PE ratios, historical PEG ratios. How do stocks usually perform when hedge funds start raising their price targets? How do stocks perform in January? How do stocks usually perform during the Santa Claus rally? Do stocks usually go up after splits? When they raise their dividends? When they're added to a major index like the Qs or the SPY? Those are all ideas that we can test mathematically with the click of a button. So yes, a strategy as simple as a simple moving average can outperform the market, the pros, the best investors in the world by 300+%. It's possible, and it's not entirely stupid, but buying 0-day expiration calls on Kohl's, a clothing company, probably isn't the best idea either. All right, that's it for me. Bye now. Bye-bye.